So a very good evening to all of you. So we're gonna discuss today the pilot paper of the strategic tax planning, or we call STP, in the strategic level. So you know that this is a 100-mark question because you have given 3 hours for writing and 15 minutes for reading and planning. So this paper consists with the two sections. Section A, a compulsory question which carries 50 marks. Section B, three questions. You need to answer any three uh, two question which each carry of 25 marks. Now there is election, you can omit a one question based on your preference. So today we going to discuss the compulsory question which carry the 50 marks. Here 90 minutes. So we go to the question number one. Apex Global Holdings PLC is a diversified blue chip conglomerate listed in CAC with a market cap of 50 billion, exceeding 50. The group operates across three primary verticals. The verticals means the same context: property development, industrial construction, and export agriculture. You are the CFO. A meeting of board of directors will be convened next meeting to finalize the annual report and strategy for the particular year of assessment of 24-25. The macroeconomic environment has been vulnerable or the violate following the government commitment to the IMF extended fund facility. The Department of IRD has initiated strict revenue-based fiscal consolidation drive. This has resulted in a surge of default tax assessment across the corporate sector, specifically targeting capital gain risk boosts as business profit and excessive interest rates. With CEF, the group chairman has asked you to resolve the five critical tax exposure that threaten the group net profit and cash flow. There is a five issues: issue one, issue two, issue three, issue four. I'm not going to read issue five. So after that, it asking 20 marks, 5 marks, 10 marks, 2 marks, 3 marks, 3 marks, 4 marks, 3 marks. So altogether, 50 marks is there. So question number one, with reference to issue one, evaluate the corporate income tax exposure arising from IRD proposed adjustment compared to the company defensive. Your evaluation should quantify the final tax liability, corporate income tax and SSC under both positions, and recommend the most tax efficient strategy for the group. It means either the IRD assessment is beneficial or company's own perspective, company defensive is just made benefited for the group. So we will discuss the issue number one. So if we go to the issue one, here you can see I know that the Apex Real Estate is a non-manufacturing subsidiary. Non-manufacturing is not manufactured. Okay, so responsible group plan bank, stock, and property asset because this is they are saying this is a vertical group dealing with property development, industrial construction, export agriculture. So issue one Apex Real Estate means this is a land selling and business. Okay. In September 2020, the company realized a significant cash inflow by disposing the prime commercial land product Colombo 4. The land sold for 120. It was originally acquired with 30 million. So, එකසිය විසර million වික්කේ, but 2019 30 million. Bought minutes from 2019. Land purchase only for the construct the Apex Construct corporate headquarters as a company headquarters. However, due to the economic crisis, in 2022, subsequent import restriction on steel and cement, the project has unfeasible because we vacate the project. In April, the following abandonment of the project, the board formally reclassified the property for PP because now it's previously PP, now it become IP. Their market value because the investment property, land or building held for sale or capital appreciation is categorized under the land or building or both held for capital appreciation or renting out others, not sale. Renting out others is categorized under the investment property. The market value 50 means now 120. If it is fair value, the fair value 50 means 70 million. There is a gain resulting a 20 million gain because previously it is acquired for 30, now 50, 20 million gain. The land remained vacant, fenced or untouched until the unsolicited offer was accepted. The IRD has issued notice regarding 70 million gain as a business profit because trading stock because this is a company we are doing real estate. Therefore, if 120 minus 50 means 70 million, it is an unrealized gain because still not disposed. Business profit, as it argues that if the group has a real estate, buying and selling the land is the ordinary course of business activities. It become inventory of that business. If you refer to case 2, Apex Real Estate funded its land bank by raising significant intercompany debt. The IRD has flagged the potential disallowance because you have a thin capitalization rule. They up to that ceiling only you can claim. Otherwise, the remaining should be disallowed and carry forward for the immediate next year of assessment. The finance division has extracted statement of financial position, profit from operation, excluding profit from prime commercial land plot after deducting accounting depreciation, but before interest and tax because 300 accounting depreciation 50 you need to add back because in order to calculate the EIT, despite that you can have the capital allowance based on the value because it is saying that acquired cost is 30 million. If we go to the answer, so 500 million building. So you, if you cost is 500 million, therefore you need to add back the county depreciation. You can claim the capital allowance 500 divided by 5% of the 20 years. 20 years because it is 25 million. Okay. Interest expense paid to working capital loan because you have a thing capitalization rule later we discuss. Brought forward loss available for set of 150, but out of that brought forward loss include investment loss because you cannot set off investment loss from business profit, this taxable income, assessable business income or the taxable income from the business. You can't do that. And issued share capital, retained earning reserves, including revaluation. You want to omit the revaluation reserve and take that as a 10 out of 15 because 15 minus 5 is 10. The total debt is 500. So you need to think what is the interest expense. The interest expense is 50, 50 divided by 500. So in order to get the thin capitalization route, because 50 divided by 500 and stated capital is 60, 30, 10 means 900. 100 4 times of that equity except the revaluation reserve, then it is 400. 400, you have the 400, 4 times of C, total equity is 100. 100 into 4 means it is 400, divided by, multiplied by 50, divided by 500. So you need to think that, and based on allowable interest is based on the thin capitalization rule, based on the thin capitalization rule is this much because if we go to that particular because the equity is if we go to that it is 550 50 500 400 not 0. So if we multiply this much into is 4 times of equity. Now equity is 100. That means 40 is allowed. 40 is allowed. Allowable interest it is 40 because you need to disallow that 10 because you need to add back because it is disallowing. So you need to add back again 10. Here allowable interest is 40 and yes, you are removing 40. No. You are omitting allowable interest means you deducting 40 because here before interest account will be part before interest and tax because interest is not there. Therefore, you can take if it is interest there, you need to add back the 60 or you need to add back 60 and sorry, add back 50 and deduct 40 or otherwise you can add back 10 because 50 is deducted 40 is allowed means the remaining excessive 10 you need to add back in order to derive the taxable income from the income from the business, okay, in order to comply with the IRD requirements. So if we go to this, because profit for the from operation after accounting depreciation 300, so you need to add back 50, because accounting depreciation not able to deduct under the taxation rule. Despite of that, you can claim the capital allowance. This is a built-in. 20 years mean 500 divided by 20 in 25 you can deduct. So the adjusted profit from operation is 325. Then you need to add the land gain, that is 70. So business, that is a business profit if it is a trading stock, because how it is 120 sale proceed, and the fair value is at that date is 50 million if the as per the question. Yes, 70 million is the gain. Here the market value is 50. So thereby you have allowable interest, you need to deduct 40, then accessible income from business if it is a trading stock 355. But you can claim up to 6 year of assessments if there is a business loss. But the here the you can see that brought forward loss 150. Out of that, 50 is from investment loss. You cannot offset investment loss against with the business income. Therefore, allowing is 100 in order to you can offset 100, and net taxable income is 255. Therefore, investment income, if it is not an investment asset, you cannot have, but you cannot claim that investment in broad forward loss set off is not allowed, prohibited as per the restricted as per the standard. Therefore, you cannot claim. And total tax liability based on the total taxable income is 255. In order to apply the relevant corporate tax rate is 30. 76.5 million is the tax liability, because SSCL is not there, because this is a liability is 2.5 based on the turnover, because no improvement is made, so no value addition. Therefore, you are not liable for a payment of the SSCL, because if it is an investment asset, this is not revenue, because if it is investment asset held for capital appreciation or something, this is not because you are exempted from SSCL, therefore no SSCL. If it is 300, again 50, you can add accounting, and capital levels you can claim, adjusted you can have. That land gain is not there, despite you have a gain on investment asset. 70 is not there, allowable interest you can take. Then 285 you can 100 offset, and 185 you can add that investment gain 70, again the net uh, taxable investment income 70 plus 285 is 80, means to the 300 350 350. So yeah, 255, not two, yeah, 70 plus 185. No, 285, no, 285 minus 100 is 185. 180 plus 70 is 255. But you apply the 30%, then that is 76.5 million. Okay. Again, it is 76.5 million you have to pay. That is the answer for the question number one. And so here you can see the building cost, and the rate is 5%, and allowance capital allowance is 25. The thin capitalization rule is there. As per the section 18 interest limitation, the deduction is interest limit to 4 times of the equity issued capitalized reserve, but exclude except the revaluation reserve. You need to remember. Okay. The boss must rigorously appeal against the assessment and defend the land as an investment asset to address the correct statutory precedent. They should submit to 2019 board. We need to prove original intent was hold the land as a capital asset. TP for head office effectively refuting the assessor's trading stock assertion. Furthermore, they must submit 2025 the economic resolution to investigate formal change to PP to IP. This sequential evidence confirm the final gain is investment income, which is critical for maintaining accurate corporate tax record, even though the final cash tax payable are identical in both scenarios due to statutory restrictions on the utilization of the group investment losses and natural absence of SOCL liability. Okay, so if we need to address that one, we can refer the answer. With reference issue to evaluate the procedural validity, I mean, this is attack administration, administrative review, and time by thing. Evaluate the procedural validity of the determination received for year of assessment and recommend the immediate course of action for the board for the appeal preserve 5 marks because issue number two. If we go to the issue number two, while finalizing the current account, the head of legal has brought the urgent matter into your attention. On 30th, because the data are important, the October 2022, the company received an assessment disallowing interest expense amounted to 25 million. The company disregard with the assessment and duly filed a request for administrative review for the CGIR 15th November 2023. Because if within 30 days you can, because the 30 days is not passed, because November 30th plus 30 days is November 30th. Before that, 15th November is before that date. Therefore, administrative administrative review is possible because May 30th October plus 30 days is not exceeding this date. Therefore, administrative review is possible. So yesterday, it means 25th June, the company received the CGIR determination dated 10th June 2025 because even though postage received this date, the determination date, assessment date is, sorry, the notice date is 10th June. The determination upholds the assessment and reject the company justification. Therefore, within 2 years of that particular validity of the determination time bar, the board concerning regarding the delay is noted. However, the technical review confirms the determination is valid. Under the 139 subsection 5, the IRD, the Commission General is granted statutory period of 2 years from the date of request for administrative review was filed to issue a determination. So, if that determination within 30 days, the board is worried about the deadline to respond, they believe that since the determination is took nearly 1.5 years to arrive, it might be time barred or invalid. They need to clarity on the validity of the recommendation next step because within 30 days of this day, this 10th June 2025, you need to go for the tax appeal commission determination received on 10th June 2025 because yes, it's correct, 10th June 2025, well within the time frame, therefore cannot challenge. Recommendation, we must file a petition against to TAC, Tax Appeal Commission, which is located in the Lake House second floor. This is the independent body empowered to hear appeals against determination made by the CGIR. Mandatory requirement for validity. You need to read this and memorize. To prevent the appeal from being rejected in time limine, we must strictly adhere a time limit. The petition must be filed 30 days of the receipt of the CGIR. The payment requirement, payment requirement. We must satisfy one of the following payment option at the time of appeal. Option 1, non-refundable. Transfer sum of equivalent 10% of the tax in dispute to the CGIS special account. This is non-refundable regardless of the appeal's outcome. Or option B, refundable guarantee. Transfer sum equal to 25% of the tax dispute, which is refundable if you win, or submit an irrecoverable bank guarantee for the same amount, 25%. Strategic recommend given the group confident technical defense to avoid sunk costs. I recommend option B using a bank guarantee. This avoids the immediate cash outflow of 10% while securing your right to appeal. Okay, that is important.